Hey, Jason, thanks for joining us today.
Hey, Brett, how are you?
I'm great.
Great to be back.
Thanks for asking. So today we're going to talk about fees, but first of all, why don't you just give a quick intro bio of yourself real quick?
Yeah, so 19th year, I think, in the industry. I've been around a couple different places to see a couple different fee structures. So, we'll be able to talk a lot about that today, thankfully. And so, really just, partner here at coreVISION Financial Group. It seems like just yesterday, Bo and I were getting out of college and trying to start something. So it's been really cool to see how things have changed over the last almost 20 years in the industry, in the financial services sector, and how things will, continue to change in the future.
So today our topic is fees. Let's talk about, like in general, you hear a lot of stuff about fees. In our industry, we hear tons of stuff about fees. I don't know that, the everyday investor knows what all fees are, where they come from, because a lot of times people say, oh, well, your fees are higher than this person or whatever. Can we talk about how fees are associated with what the services are you receive and what account types will have what types of fees with them?
Yeah, it's a good place to start. There are different ways in this industry that financial services companies can choose to structure those fees. And a few of the main ones that I think people listening to this have probably been exposed to, more of the commissionable type transaction fees you see inside accounts, and then also how we run most of our business here, which would be assets under management as a percentage from an advisory fee standpoint. So, those are the main two that I think you're going to see, that people will see and people really need to be cognizant of. And real quick, I just want to kind of note that the main reason I wanted to talk about this was because I think so many of our clients and so many people, especially when they meet with someone in the financial services industry, are kind of afraid to talk about it. They're afraid to ask about it. They're afraid, and it's one of those things. And I always tell people, we as fee-based advisors, we do that for transparency. We want to make sure that clients can see on a statement exactly how much they're paying us, to the firm. And we also want people to, when we review with those people, we want to be able to show them, a true net rate of return versus, hey, here was your rate of return, but then, we had fees and things in there. So, we always like to show them, exactly where that falls and exactly how much they've paid us over the last year, 2 years, or whatever. So, we like to be transparent about it because I always tell them, if I'm you, I want to know what I'm paying and what I get for it. And I think that's the most important question that consumers can ask when they're meeting, even if they're meeting with their advisor that they've been working with for 20 years. And we go back to kind of why another reason I wanted to do this is because so many people that I talk to don't know how much they're paying, what they're paying for. A lot of people don't know if they are in a fee-based type account or in a commissionable type account. And that's okay. I'm not blaming them. They don't do it every day, right? And I'm sure at some point that advisor had explained to them what that situation was, right? People sleep, people go to work, life happens. And so, it's just, I want to kind of bring it full circle to make sure that people really, this is a fee conscious industry. And so within that, we are always trying to find ways that we can either keep clients' fees as low as they are now, or in some instances, hopefully be able to lower fees in the future. And that's tough. And why that's tough is because the things that we have to pay for to keep everything in any business, right? The costs associated with doing business do nothing but increase with inflation. Perfect example was last year, right? So we had negative year in the market. When you are managing assets at an asset under management fee-based level, that's not going to really do a lot of good for your revenue numbers. So, but at the same time, we had a year with giant inflation numbers. When you're operating in the financial services industry in a fee suppression type atmosphere that we live in, we have to figure out how we continue to pay more and more for rent, payroll, software. All these things are going to get more expensive over time. That's just going to happen. And it's an industry where, from a fee standpoint, it's going to go down, right? So that doesn't get more expensive. Yep. So, constantly you've got to be trying to do things in order to use economies of scale in order to pull back on some of those expenses so that you can put a lot, reinvest that capital, people, software, office space. So it's a tough thing to migrate, and you tiptoe through it and you do the best you can.
And I think last year is a great example of that you're talking about. So when you talk about assets under management and fee-based, when those accounts lose, let's say 17%,
Right.
18%. The account value is down 18%. The revenue off of those accounts
Naturally going to fall.
be down off. And then you add on top of that inflation, 9%. You know, you're looking at all these things costing more while your revenue's down. So, yeah,
Correct.
from a business operating standpoint, fees and their structure are a huge part of how you run your business. So a lot of times people only look at the fee schedule from the side of the client, but you know, understanding, hey, why are these fees necessary? How do they play into what the advisor does? You know, I think that's an important aspect of it that most people don't ever talk about. So when we start talking about managed accounts, you know, and the associated fees with that, so let's just talk about real quick, how's that work?
Yeah, great question. So, and how we operate most, you know, for the most part is, you know, having those accounts, those assets under management, and just charging a percentage fee on those assets. It's really nice because for me, it makes me feel like I'm sitting on the same side of the table as a client. You know, we don't run into the issues where, you know, from a commissionable aspect, you know, we something has to happen to generate revenue, right? Where in a fee-based approach, what's really nice about that is I, as the advisor, have a vested interest in you as the client's account doing better. You know, I have a vested interest in that doing better. Now, we can't control the market. We never will be able to.
Right.
But at the same time, you know, it's more of a partnership at that point, and that's kind of how we feel about it. You know, we're working in tandem with the client, being able to do the best job for them that we can, given their risk tolerance, their time horizon. How do we get low-cost underlying investments that are really good into these accounts and constantly try to make it more efficient? Because think about it this way. If as a percentage, like the client pays as a percentage, the idea is that we as the advisors are going to work our butts off to try to do the best job we can, given the parameters of the client, to do the best we can for them. Because if we can be more efficient with underlying investments and bring the costs of these costs down for the client and work with them on that, that's more money the client's going to have. And for us in this office, not every office is like this, but for us, it's a marathon, not a sprint. You know, Bo and I go back, you know, Brent and Bo and I, and even, you know, other people weighing in on the fee conversation about, you know, hey, you know, we need to reset these fees, where we at, or what are these going to be going forward? And, you know, it's one of those things where, you know, you don't want to devalue what you do. You know, you want there to be value there. And the way that we choose to do that is while we're able to keep fees about as low as anybody around, the value added that we're providing on top of that without charging additional dollars for planning services and, you know, the time part of it, you know, it's being able to have that value added of having those other ways in order to help people plan for retirement, plan for college funding college educations, plan for those kinds of things. And that's an ancillary part of that. That's all inclusive of that fee, you know? So we're not a place that's going to, hey, this fee's to advantage this, and then you got to write us a check for this, and then you got to do this. It's, you know, we try to create that value by saying, hey, this is the package. You know, this is what you get and what you have access to. You know, now that's another part of that's very important. This is still a two-way street. The client still needs to be involved, and, you know, there's some time there, but, you know, we try to make it as easy as we can.
So when we talk about assets under management and the way those managed accounts will work and the fees that are associated with that, I don't know if we want to get into exact numbers, but if you say, you know, annually it's
per percentage, yep.
Yeah, and then it calculated on the quarter, right? You know, 25% of that fee is taken out each quarter. Yeah,
the way it's set up for the most part is, you know, the accounts pay their own fees, you know, and I talk to clients about that. You know, I like to view each account as kind of its own business. You know, let it make its own money, let it pay its own taxes, let it pay its own fees, you know, so that works out really well. I mean, it keeps it very straightforward. So, you know, national average is going to be around 1% is what a lot of people are going to see. Now it's going to depend on, you know, the amount of assets and things of that nature for a lot of places. You know, some places will have a tiered structure where they charge a certain percentage on the first so much money, and then they lower it on the next. So it's almost the tax system, like the tax bracket system, right? You know, and then others like us, you know, we are a flat. We don't have a tiered approach for each account. So, you know, really that's an annual fee that's billed quarterly.
So the management fee on an asset-based account is somewhat newer. You know, historically and traditionally, people are more familiar with the commissionable and how those fees are calculated. You want to just touch base with that and then kind of say, hey, you know, this is how it used to be, this is how it is now, kind of what's the difference?
Yeah, it's kind of the antiquated system, if you will, in a way, is more the commission-based. And, you know, with that, it's a transaction-based system to where, you know, if you've got an account somewhere, you know, if you've got an account and there really isn't any revenue generated unless there are trades made, right? And or more money's brought into the account with trades made, so you've got trade costs, and then you have upfront costs on a lot of those, you know, investments that you went into, buy into. So that's called a front load, a sales commission on the front. So, you know, that's really kind of the antiquated way that
I mean, historically,
works.
that's how advisors got paid.
Correct.
Right? They sold a commissionable product, received a commission, and then went on about their business.
Yeah. And with that, there are some nuances with being able to move in and out of fund families without additional costs. You know, I don't want to really get into all that without being able to, you know, that's just, that'll get tough. But, you know, what the biggest thing for me on the commissionable versus the fee-based of how we operate now, the biggest difference I see is that when you're in a commissionable situation, which I started in, I mean, I started out of college in 2004 and was in a commissionable type position in the financial services industry for 6 years before we peeled away and did this. So I've seen both sides of it, so I'm allowed to talk about both sides of it. And the part that troubled me was that, we know the 80-20 rule, right? 80%, 20%. I mean, you can apply it to almost anything in life, you know? And the problem that I had with that in the commissionable system is that in order to live, in order to make a living, you had to spend 80% of your time out trying to get new clients, because we just got on saying that that's when you make money, is the only time the revenue is generated is when there are trades made, new money comes in, things of that nature. So I just got to thinking about it. I was like, in this setup, you've got 80% of your time that you're going to be out spending trying to cultivate new clients and get new clients, right? Well, that only leaves 20% of your time with your current client who have already made the decision that they're going to trust you, that they're going to work with you, and that they're going to be invested in working as a team for their financial future, right? They made that decision.
Yep.
And that was just backwards to me. And so I thought there's got to be a way that we can flip this, because I don't want to spend 20% of the time with the people who have invested in me, right? It just seemed backward. 2012, 2013, Bo and I made a conscious effort that we're going to just, you know, switch over, and we're going to do as much in that fee-based arena as we can, because we don't want to have 3,000 clients. And guess what? Our clients don't want us to have 3,000 clients. There's just no capacity there, right? So that's really a big part of the thought process of what really made us flip that switch, you know, after 6 or 7 years of doing it the commissionable way, really try to, you know, flip that switch and do almost everything in the future in that fee-based model.
So when you do commission-based, you know, and the fees that are on every transaction, right? And anytime you would call up your advisor and be like, hey, I want to buy, you know, 10 shares of something, there's a commission on that. So, you know, historically, and I don't know if we even want to get into this really, right, is that's where we've seen some discrepancies or dishonest work by advisors to where they're pressuring people to buy stuff because of the commissionable activity that they'll get paid on. I mean, I don't know if we even want to get into that, because that's just a whole nother.
It's a whole nother rabbit hole to go down.
Yeah.
I mean, it's just, that's what it is.
Okay, so inside products, investments, you know, other things that you would buy through an advisor, there's going to be additional fees in there. Sometimes we talk about expense ratios and internal fees and 12(1)B fees and those type of things.
12B1.
So real quick, can you just touch on those?
The one thing about the investment world, and I think a lot of people, you know, could realize this, is that you got a lot of layers there, right? And, you know, if you take a look at how we're set up, I mean, from a layer standpoint, we have our company here. We choose to custody with LPL Financial. So there's another layer. Then within accounts, we have individual investments, whether that be stocks, ETFs, mutual funds, bonds. There's another, sometimes with those, there are more layers. So you have to be really cognizant of the layers of fees that exist. And as a consumer, you know, it's really important that you kind of think about that, because, you know, some of these accounts that could be, you know, take a commissionable account that you pay a 5% upfront sales load on, right? And then you're going to have
on a commission. There's kind of a range, isn't there? Right?
There is a range, and that range is anywhere from 0 to 5, usually 5.75%, depending on the amount of money you put with that fund company. So now we even get into, you know, how do we keep the layers happy, right? Like how do we put things here and to make the cost as low as possible. And so, with these layers of fees, literally just keep adding these things up. And you might think that you have an account that doesn't cost you anything annually, but then when you put really the pencil to the paper, you take an upfront sales load of 2 to 3 to 4 to 5%. And then on top of that, you've got an expense ratios inside that the fund company receives. Representative gets a little bit of that, It's just all these, just a lot of layers. And before you know it, you could be at 2% a year in a commissionable account and not even know it on an average, and you get into some of the other commissionable type products, because it's less, they're so less transparent and they're not on there and you just don't see it all the time. You know what they're going to do? They're going to send you a book that's about this thick. It's called a prospectus. If you have trouble sleeping at night, grab one. Within that prospectus, if you go through and you somehow figure out how to read it, because they're really hard to read, and decipher which fees apply to your account, you could be at 3% in a second and not even realize it. That's almost long-term inflation average.
Yeah, right.
And to be paying that in a fee, is just works so much against the returns that over time, let's take 2% of that net, right? If you're used to paying, if you've got a 1% versus a 3%, 2% net compounded over 10 years, but could be a big number.
Could be a very big number.
Could be. What I really like about the fee-based advisory model compared to the commission model is it's very simple. The commission model, like I said, it's hard to really decipher even what you're paying in your own account. You don't see it. And I think it's so much easier where a client's able to open a quarterly statement and it says fee, and it has a number, and they're able to see that. It's just easier to relate to.
Sure. Well, it's just right there in print.
Right there.
Anything else about fees that you think we're trying, as we're just talking, that somebody who's a beginning investor or, doesn't work in the industry would want to know about fees?
I think that the biggest thing to think about and realize and understand, one of those things for me, and I go back to really kind of knowing what you're paying and what you're getting for it. I can't stress that enough. And, there are times that, I even talk to clients and I realize that I've, over the last year, I need to do a better job sometimes of, letting people know like, hey, these are the things that you have access to. This is what we're going to do for you. Now, depending on where people are in their lives may not make sense for some versus others, but, right. Always being cognizant of what's out there from a value standpoint of the underlying ancillary things that go along with working with an advisor. And the reason I think that's so important for people to understand is that we're in a society now that would promote people to self-invest. It's as easy as it's ever been, and it's going to do nothing but get easier. Right? That's the society we're in. And for those people that want to do that and don't need that advisor, that's great. Do it. And you enjoy it, you have an affinity for it, you have a passion for it, go for it.
Yeah, if you're willing to spend time.
If you have the time, willing to spend it, comfortable with it, trust yourself, go for it, right? That's awesome. For those people who, want someone to talk to when the market's down, just to hear somebody say something to them rather than read something in the news, that's why we're here. This is no longer an industry that just manages money, right? We can't be, because you can do that by yourself easily. I think it's very important for people to really understand what they have access to with who they work with and know what they're paying to get it.
Yeah, I 100% agree with those sentiments. Anything else you want to cover before we end this up?
No, I think that's it. I think it's been great.
Yeah.
It's a nice little fee discussion.
Thanks for being on the podcast. I appreciate it.
Hey, thanks for having me.
Hey, again, Brett Rice with coreVISION Financial Group. Today's guest, Jason Pike. Thank you for being on the podcast. Go to our YouTube page and subscribe. You get notified when we post a new video. Please, if you ever have any comments, questions, please feel free to reach out. Our contact information will be at the end. Again, thank you very much.